Christmas shopping has officially started, and what's better than buying yourself a few great stocks? I recently found these 3 amazing undervalued stocks that have been flying under the radar. If you want to learn more, stick around and please leave a like to show some Christmas love to the channel. First of all, we have VICI Properties, which trades under the ticker VICI. VICI Properties is a REIT, meaning a real estate investment trust. Now, REITs typically don't strike you as amazing or undervalued, but VICI Properties is very unique. What VICI do is they target specialty net lease properties, such as casinos, and build really strong relationships with casino operators. One way to tell that their relationship is great is the fact that VICI's tenants on average have 43 years remaining on their leases, compared to the average of about 8 years with other REITs. We can also tell that their model is working by the fact that VICI Properties have maintained 100% rent collection through COVID, when its peers would only collect 60 to 80%. They are also expected to grow earnings at an astonishing pace of 37% per year over the next 3 years, despite currently trading at a discount of about 30% to its real estate peers. VICI Properties has a PEG ratio of 0.5, a PE ratio of 17.5, and a price to funds from operations ratio of 15.6. They recently issued additional shares to pay off debt, but diluted ownership in the process and led to a lower share price. On the bright side, this offers a great entry opportunity. VICI Properties currently trade for about $28.5, with the average analyst target price being $36.77, which means that VICI is undervalued by about 22.5%, which gives us an upside of 29%. On top of it all, VICI currently have a dividend yield of 5.1%, and they have increased their dividend every year for the last 4 years. Overall, VICI is an undervalued stock with an attractive dividend and a good bullish case. The next undervalued stock on our list is PulteGroup, which trades under the ticker PHM. PulteGroup is the 3rd biggest US home builder as of 2021. They acquire and develop land primarily for residential purposes, and as of December 31st, 2020, PulteGroup controlled 180,000 lots. PulteGroup is obviously a big player in the home building space with a market cap of $13.3 billion, but is it undervalued right now? Short answer, yes. PulteGroup currently trades at a PE ratio of 7.8 compared to the industry's average of 11.1, and it only has a PEG ratio of 0.5. PulteGroup's forward PE ratio is also just 5.8, which is also extremely low. Their earnings are forecasted to grow by 15.7% and their revenue by 13.2% over the next 3 years. Typically, companies that are this undervalued show red flags, but let's take a look at their financial health. Over the last year and a half, PulteGroup has been paying down debt while increasing cash reserves. They currently have a debt-to-equity ratio of just 35.5%, with a debt of $2.5 billion while having considerable cash reserves of $1.6 billion. Another indicator that PulteGroup is doing well is the fact that they have bought back 20% of their outstanding shares since 2017. Plus, PulteGroup is paying a small dividend of 1.1%, but they have raised that on multiple occasions over the last 7 years. With an average analyst target price of $65.5, PulteGroup is undervalued by about 19.6% given its current price of $52.65, resulting in a possible upside of 24.4%. Overall, just like VICI Properties, PulteGroup is an undervalued stock with decent growth prospects and a small but stable dividend. The final undervalued stock on our list is Euronet Worldwide, which trades under the ticker EEFT. Euronet Worldwide provides payment and transaction processing and distribution solutions to financial institutions, agents, merchants, and more worldwide. Their most lucrative part of the business is currency conversion fees from cross-border ATM withdrawals. As such, their business has suffered a lot due to a travel slowdown which resulted from COVID restrictions. However, I think that its current price of $114.3 does not reflect their true potential. Analysts agree with me, setting an average target price of $172.86, which means that Euronet is undervalued by about 34%, which gives us a roughly 51% upside. Euronet currently trades at a PE of 41.9, which is high, but again, that's due to the drop in their business due to COVID. As travel restrictions are lifted, their growth will be boosted. In fact, their PEG ratio is just 0.7 and anything under 1 is essentially undervalued, according to established investors like Peter Lynch. Euronet is expected to show a 61.9% earnings growth and 14.8% revenue growth over the next 3 years. The company is also financially stable, and even though it has a debt-to-equity ratio of 80%, they have 1.7 billion in cash and cash equivalents compared to a debt of only 1.2 billion, meaning that they're in no financial problem. Overall, Euronet is another undervalued stock that can jump in price, but there's the additional risk there of travel restrictions. So, these are 3 of my top undervalued stock picks for December. What do you think? What are your top undervalued stock picks? Let me know in the comments below. If this is your first time here, please leave a like and share with anyone who may find this interesting. If you want to follow my future undervalued stock picks, make sure you also subscribe. Thanks for watching, and I'll speak to you again in the next video.